Hello everyone, welcome to the Fundamental Analysis tutorial series for traders. Today we are going to talk about another topic, so let's get started. So today we are going to talk about GDP and Buffet Indicator, how we can use GDP as an investment tool. So let's discuss what it is. So let's first of all see what GDP is. GDP is a leading indicator of any country's economy, and we determine this by assessing the monetary or the market value of finished goods and services produced within a country's borders in a specific period of time. And GDP is calculated on a yearly basis as well as on a quarterly basis. And when we have a quarterly data, it shows that whether the economy is expanding or it is contracting. So it gives us insight into whether the economy is going good or the economy is going bad. It also gives us an analysis of how one country's economy is performing against another country or other countries. So it's a yardstick that tells us the performance of a country's economy against other countries. And a country's GDP takes into account all of the private and public spending and output, investment, and net exports. So let's see how we can use GDP when the GDP data or figures are out there in the public. Then how we can use that data for investors and traders. So if the actual figures upbeat the forecast, they are higher than the forecast on the positive side, then it provides bullish opportunity for traders and investors in the securities related to that particular country. And now we have a Buffet indicator. We all know that Warren Buffett is a very successful investor who has invested heavily in the US stocks, and based on his experience he has given one analysis of one indicator where he has made a lot of successful investment decisions. So we also call it a Buffet indicator because when he mentioned that, so now it is known as Buffet indicator. So let's see what it is. So we determine Buffet indicator as US stock market capitalization or valuation divided by GDP. It gives us the capitalization to GDP ratio, which is actually also known as Buffett indicator. And this valuation ratio provides equity investors and businesses about the equity market, whether it's undervalued, overvalued when compared with the historical average of data. So now let's see what does it mean. So if we have a figures ranging from 50% to 70%, that means the stocks are undervalued. If the figures range between 75% to 90%, it means the stocks are on a fair value level. And if they range from 90% to 115%, it means the stocks values are overvalued. So this is how we determine Buffet indicator or capitalization to GDP ratio. And then on the other hand, Federal Reserve uses GDP as the most significant component in setting up its monetary policy. So they adjust their monetary policy according to how the GDP is performing. So if the GDP is declining for a longer period of time, so they adjust their monetary policy according to that. But if the GDP is higher and economy is overperforming or overheating, then they have different monetary policy. They use different monetary tools to cool down the overheated economy. In this case, they have this interest rate. They increase the interest rate to cool down the economy. So what is the importance of GDP? GDP is very important measure of a country's economic health, size, and it also influences the direction of the financial markets. And the pace at which the economy grows affects businesses, investment decisions, as well as whether there is more employment or no, or there are more jobs or not. So when GDP is rising, the economy is typically deemed to be doing very well. Employment can be expected to increase as companies expand. They hire more workers, and when they hire more workers, so people have more money to spend. So this generates a positive cycle, and then it keeps going on and on. But when the GDP is shrinking, then opposite occurs. Businesses suffer. They are not expanding. They are not hiring. They are laying off people. And when they are laying off people, people income becomes less, so they don't spend any more money. So it's a kind of a negative cycle that goes into with the declining GDP. So that's about it, guys. Thanks for watching. I will see you next time. Have a good day. Bye bye.